Good morning.
Good morning.
Can I still say that, or am I not early enough? Oh, I can't say that. Good afternoon.
This is model morning, right?
Good model morning to you.
That's right.
Good afternoon. I'm Cynthia. I'm here with Doug, and we'll help you make money in the stock market with information you will not find anywhere else. We can guarantee that.
This is yeah, sometimes better, sometimes worse.
I don't know.
This is rock star time. We've got Rich Gordon.
Rich Gordon?
Oh my God!
We love Rich Gordon.
Set new records last week. You know why? He's a rarity. You got a smart, ethical guy on Wall Street that everybody looks up to, and he's commenting. What's he talk about today?
Sounds like oxymorons. Wall Street and all that stuff.
Hey. You'd be nice. It's going to be spanking time on the show again.
Oh, no, not that again. Please, don't send the letters again.
That's right. If they all tell me
Last time you spanked me, you know, the mailman came up. He was very upset with all the letters he had to carry in.
I know, but we got great ratings. You know, but we're Rich Gordon. We don't need that for today. Rich Gordon is Wachovia's fixed income strategist.
We don't have to go that low. We have Rich Gordon.
That's right. Tomorrow, however, I make no promises.
Tomorrow, I may be doing some field reporting. Possibly.
Tomorrow, we've got super cool, again, Peter Guber, Chairman and CEO, Mandalay Entertainment, formerly studio head. I idolize him. Super smart guy, and he's fun and clever. And we'll have him bright and early tomorrow morning for you.
And I may be field reporting.
I'll call you while you're out. What do you usually do? You're usually home by 9? He starts at 8:15. About 7 o'clock, I'm going to give you the heads up so you can try to settle your evening up, okay? And we'll have you swing by.
Probably be, maybe a bungalow,
Studio
54. Anyway, so let's get into some real news.
Okay, what's Rich talk about today?
Rich Gordon talked about fixed income market strategist of Wachovia Securities. And WB discusses the U.S. government's $700 billion plan for a federal commitment to buy distressed mortgage loans and to assure money market funds.
He makes some great points in here that I wasn't aware of, even after all the press coverage.
Cut to the clip.
Late last week, the U.S. government took steps to halt the rapid deterioration in the financial markets by announcing a plan for a huge federal commitment to buy up distressed mortgage loans and to insure money market funds. The government's proposal includes 3 key parts to try and stabilize financial markets and keep the economy out of a severe recession. The first part is a money fund insurance program to keep them from breaking the buck. The second is an ABCP buyback program that allows banks and bank holding companies to purchase asset-backed commercial paper from money funds at par and then finance them at the Fed. The last piece of the proposal is the Treasury's Troubled Asset Buyback Program, which is designed to systematically remove bad mortgage-related assets from the balance sheets of U.S. financial institutions. The potential cost of the plan is as much as $700 billion. In its purpose and scope, it has similarities to the RTC program instituted in 1989 to help remediate the S&L crisis, as well as to the RFC program that was part of the New Deal legislation in the 1930s, when the U.S. coped with a surge of bank failures during the Great Depression. Systemic risk factors have been increasing for weeks, but the near failure and rescue of AIG and the actual failure and liquidation of Lehman Brothers finally clarified how severe the situation had become. The losses on Lehman's short-term debt caused one of the largest money market funds in the country to break the buck. As prime money funds got flooded with redemption requests, others would have had to be liquidated. That, in turn, would have destabilized some large, healthy, non-financial companies that rely on money markets for a portion of their funding. Here are some of my thoughts on how the dramatic events of the past 2 weeks will affect the financial and business landscape going forward. First, was a bailout of this magnitude really necessary? I think that reasonable people can agree that one of the government's priorities should be to try and keep the country out of deep economic hardship. And the likelihood of an immensely destructive deflationary spiral increased sharply last week before the government announced the program. In my mind, the single biggest factor in having a functioning financial system at a minimum is that people simply have to believe that if they set aside money for savings, they won't get back less than they deposit. It's why some people literally stuffed money in their mattresses during the Great Depression. They had lost faith in the safety and soundness of the banking system at the time. Over the last 2 decades, an increasing portion of our savings complex has been tightly linked with the capital markets through 2 main sources: money funds and insurance company savings programs like GICs and annuities. This is why one component of the government's plan provides a par guarantee for investors in prime money funds. It's also why the government chose to essentially nationalize AIG last week but keep the creditors whole. In addition to the systemic shock that would have occurred from liquidating its more than $1 trillion balance sheet, literally millions of Americans save for retirement through insurance products provided by AIG and others. Due to a combination of financial leverage from easy monetary conditions and too much structural leverage from credit derivatives, financial balance sheets became intertwined and vulnerable. As the credit crisis deepened, and even the largest financial firms rapidly lost their access to both capital and liquidity, tens of millions of ordinary Americans were directly staked in its successful resolve. Second, the changes that are going on in the financial sector aren't cyclical, they're secular. Of the 5 independent investment banks at the start of the year, only Morgan Stanley and Goldman Sachs remain as of last week, and both have gotten approval from the Fed to become bank holding companies. They've decided that they need a stable source of retail funding in the form of deposits. And so Wall Street, as we knew it, has ceased to exist. When investment banks morphed from simple advisory and brokerage services into trading giants, they became very dependent on 2 things: a lot of leverage to maximize their returns and liquidity lines to fund their trading activities. Over the past month, it's clear that investors won't accept this operating model. In my opinion, the large financial companies of the future will have commercial banking, investment banking, and asset management under one roof. Their leverage ratios will be much lower, and they will be tightly regulated going forward. Third, the bailout seems to have reduced the concerns that the U.S. was descending into an extended period of asset deflation. Treasury bill yields had literally collapsed several days ago and even briefly traded negative. Under this extraordinary set of circumstances, investors paid more than par for a security that matures at par in several months and doesn't pay a coupon. That can only happen when the credit markets are essentially non-functional. After the bailout, 3-month bill yields backed up to 83 basis points, but despite this pullback, the TED spread is still at elevated levels. Credit markets were calmed by the news of the government's proposed programs. After falling to an intraday low of 1134 on September 18th, the S&P had rallied 6.5% by the close on Friday, although it gave back some of those gains on Monday. Credit spread markets also rallied, with IG CDS 10 tightening by 52 basis points over the last 3 trading sessions. Financial spreads in particular performed well after the announcement. The average of the CDS of the 5 largest banks has tightened 133 basis points from the wides. The last thing I want to talk about is that after Morgan Stanley and Goldman Sachs announced their intentions to establish a presence in the commercial banking business, and some of the details of the government's plan began to emerge, regional bank stocks fell sharply. The increased competition for retail deposits from the former investment banks is expected to raise the cost of those deposits and put pressure on the bank's margins. The KBW Regional Bank Index dropped 10.5% on Monday. The price decline also reflected concerns that small and mid-sized regional banks probably haven't marked their assets to market clearing levels. Some may even be carrying loans at par that would actually be bid tens of points below that level. As the reverse auction process unfolds, these banks may be forced to confront the lower valuations and, based on fair value accounting requirements, could result in additional write-downs that keep their earnings under pressure for an extended period. So it's possible that the government's bailout actually ends up accelerating the losses that banks have to absorb, which makes it even harder for them to raise capital. Something that might help is that the Fed loosen the restrictions on large private equity investments in banks. We need capital to move from the firms that have it to the ones that need it.
Well, thank you, Rich. And you know where to find us. We're here every day at Wall Street Media, WSMCO.com. Have a great afternoon. Say goodbye, Doug.
Goodbye.